Good morning and welcome to today's market briefing. Let's start with a quick recap of Wall Street overnight. The three major indexes closed mixed but essentially flat. The Nasdaq ended at 25,476 points, the S&P 500 at 7,358, and the Dow Jones Industrial Average at 51,848. However, futures markets ticked higher in after-hours trading, with Nasdaq futures up 0.22%, S&P futures up 0.12%, and Dow futures up 0.24%, offering a slightly positive tone for early Asian trading. But the regular session was a different story. Market sentiment was suppressed by hawkish comments from Federal Reserve Governor Michelle Bowman. She suggested that if core inflation remained stubbornly high, the Fed might not only pause rate cuts but could even consider raising rates. That statement directly pressured risk assets. Tech heavyweights were mixed, with the QQQ ETF falling 1.92%, the SPY down 0.54%, Nvidia down 0.84%, and Tesla down 0.65%. Notably, the iShares Bitcoin Trust, or IBIT, dropped a sharp 4.08%, significantly more than Bitcoin itself, which fell 0.85%, and Ethereum, which was down 0.63%. This suggests a rapid flight of capital from leveraged products, a clear sign of tightening liquidity. Now let's look at the global macro picture. The yield on the 10-year U.S. Treasury note fell 0.61% to 4.38%. This is an interesting signal. Despite the hawkish rhetoric weighing on stocks, long-term rates are declining. This indicates that the market is more worried about the outlook for economic growth than about the fear of rate hikes. It is a classic risk-off signal, not a sign of genuine liquidity tightening. The VIX, often called the fear index, dropped 4.19% to 17.85. It remains well within the normal range of 15 to 25 and has not entered panic territory. This creates a short-term divergence with the decline in stock indexes, suggesting the market is not yet in extreme fear. But we should stay alert. If the VIX quickly breaks above 20, it could trigger programmatic selling. The US dollar index edged up 0.06% to 101.58, remaining broadly strong and putting pressure on emerging markets. In commodities, WTI crude oil traded around $69.81 a barrel with small fluctuations, caught between demand concerns and supply disruptions. Spot gold rose 0.84% to $4,043.40 an ounce, as money flowed into traditional safe haven assets, further confirming the risk-off environment. Let's turn our attention to China. The renminbi is sending a positive signal today. The onshore rate was quoted at 6.7875, and the offshore rate at 6.8025, both showing modest appreciation. The offshore renminbi has reversed its recent depreciation trend, which is encouraging. It suggests that offshore funds are not aggressively shorting the renminbi in response to the Fed's hawkish stance. This provides a relatively stable external exchange rate environment for the A-share market. A stronger renminbi directly benefits northbound capital flows by lowering the currency hedging costs for foreign investors. If the offshore rate can stay below 6.80, it will create favorable conditions for net northbound inflows. On the geopolitical and trade front, there are new developments in the U.S.-China technology rivalry. Reuters reported that the U.S. House of Representatives has proposed an amendment to the AI Innovation Act aimed at further restricting China's access to advanced AI semiconductor technology, specifically targeting HBM memory and certain EDA software. In a direct response, China's Ministry of Commerce announced an anti-dumping investigation into imports of optical fiber preforms originating from the United States. This is a clear and fresh catalyst for the market. Based on all this, our pre-market sentiment assessment for today's A-share open is a higher probability of a positive start. The combination of slightly higher U.S. futures, a stronger renminbi, and the emotional resonance of domestic substitution and retaliation is likely to push the market higher at the open. For the indexes, the Shanghai Composite is expected to trade with a firm bias, potentially gaining between 0.2 and 0.8%, while the Chinext board may show relative strength. The main theme is crystal clear: domestic substitution and self-sufficiency. Sectors like optical fiber, printed circuit boards, and passive components are directly activated by the anti-dumping investigation on U.S. optical fiber preforms, which is the most definite event driver today. Another key theme is data center and computing infrastructure, including high-voltage transformers and optical modules. The U.S. restrictions on HBM actually strengthen the domestic substitution logic in this area. However, investors should be aware of the risks. We recommend avoiding U.S. tech semiconductor companies, particularly in packaging and materials, especially those with high overseas revenue exposure. Their valuations will likely remain under pressure. Also, be cautious with stocks that simply track the external market without a solid domestic substitution narrative. These are prone to rally and then quickly fade. Do not chase them. Northbound capital flows are likely to be positive today. The key signal to watch is the net inflow in the first 30 minutes of trading. If it exceeds 3 billion yuan, it would confirm the return of foreign capital. Let me give you a concise directional conclusion. The escalation of U.S.-China tensions is catalyzing a structural shift toward safe havens. The domestic substitution theme in A-shares is very clear. The overall market is likely to be firm, but do not chase high valuations. Our probability assessment for today is 20% for an up day, 55% for a sideways move, and 25% for a down day. Thank you for watching, and we will see you in our next program.